Good morning, everyone. Welcome to this update for global stocks and commodities for the 11th of August. Yet another highly volatile week, and I think going forward, it's pretty obvious that we're just going to continue to have periodic bursts like we've had in the last week or two that are triggered by headlines that don't really change the big picture at all. So, get used to it. You're going to have to factor that into your trading and investing plan that this is going to be the way that it is in the future. The financial system is just so incredibly stressed with central banks, just pushing us more and more into completely unknown territory. And I don't think anyone really has any idea of how equity markets are going to respond to that. But the trends are still in place. There's been we've not formed a top. We're not rolling over into a bear market, despite a lot of what you might read. It's really just these little bursts of volatility, which, if you're prepared for them and know how to play them, can actually be quite useful. So let's jump in and take a look at the action. As I said, just get used to the noise. It's going to be a feature of the landscape in the future. This time around, or the week before, it was the Fed and Trump. This week it was currency devaluation was the trigger. It doesn't really matter that much what the trigger is. It's important to understand what is driving these very sharp moves in the market, and that's what I want to have a look at in this particular edition. Because when you understand what it is that's really driving markets, it makes it easier to live through them and to make some clear-headed decisions. We'll look at the normal stock and commodity trends, and Portfolio Analyst last week just had another follow-up look at the water treatment sector, which does offer some terrific long-term opportunities. And there were a number of member questions, which I guess is always understandable when we see going on what happened last week. And that's, the question in varying forms was, is it time to panic? And the answer to that, of course, emphatically was no. It's never a time to panic. Even if we get to the scenario where we roll over into a lengthy bear market, there's always a second and third opportunity to get out at a better price than the initial sharp plunge that might occur in the first few days. So just bear that one in mind. So don't ever panic. Just work your way through it, and there's always opportunities to get out under better terms. So American stocks for the week, despite the volatility, the S&P only fell a pretty minor 14 points in the end. So it was only just less than 0.5%. And it's important to understand that most of the recent price action really is a complete nonsense. It's algorithms doing what they're programmed to do, to place buy and sell orders according to certain words or key phrases that they pick up in the media. And also there is this reinforcing cycle in both directions that is caused by the ETF market. And I've spoken about this on numerous occasions before. But what happens in the sort of decline that we saw for a couple of days last week is that the selling triggers ETF redemptions, which triggers for more selling, which triggers more redemptions, and so you get this reinforcing spiral that can either go up or down until it finds a level where it stops, and then it can reverse and do something different. So just understand that these are not human beings that are making this decision, and therefore there's actually some meaningful substance to it. A lot of it is just automatic computer programs just doing what they're programmed to do, and therefore it causes short-term volatility, but it doesn't actually change the trend. And I think it's really important to understand that. Now, also the headlines about currency manipulation. The US administration this is a marketing exercise for them. This currency manipulation is what central banks should do. That's what a central bank is there to do. It's to manipulate their currency to help control the flow of trade and to help control the economy. So to be pointing the finger at China and saying they're a currency manipulator is just a complete nonsense marketing exercise. So forget all that rubbish, because it's just for public show. The real question, and just getting focused back on the charts, forget the short-term noise. The only question that I don't have the answer to at this stage, it's too early, it'll probably be evident within 2 weeks, is this just a one and done dip straight down, straight back up again, like we've seen over and over and over again in the last 5 to 10 years? Or is it a longer term, not longer, so much longer term, but a longer process where we go through an ABC decline? So we get a first leg down, that's the A leg, we get a bit of a rebound as the B leg, and then we get the completion of the pattern with a C leg down. I don't know the answer to that yet, but we'll see it unfold in the next few weeks. Either way, it doesn't really matter if you're a medium to long-term investor. I guess it matters a lot if you're a day trader, but day trading's a pretty hard gig. Now, earnings season in the US is the number of beats on expectations is slightly above average, and the earnings per share declined 0.7 as a whole. Now, before you panic and think that's terrible, you've got to remember that these are comparisons with 2018, which saw earnings go up 25% because of the tax cuts. So earnings per share growth from into 2019 was always going to be negative to neutral at best. So earnings season is still going along quite okay. Healthcare and financials are the best, and materials and industrials were the worst in terms of beating expectations. And that's pretty much a reflection of what we're seeing around the world, and that is the industrial manufacturing sectors around the world are struggling, and the services sectors are the ones that are carrying the load, whether it's the US or China or Europe or even Australia. That's pretty much the theme that we're seeing around the world. I always come back when I'm trying to decide where a market is most probably likely to go. I always come back and try and look at it through the lens of vested interests. The big players, governments, central banks, major institutions, what is in their vested interest? Because that's normally how it plays out. And when you look at America, Trump has an incredible vested interest in keeping the stock market up. So that's why I don't think they're going to pursue a line that sees the US stock market fall over. They've only got 15 months to the election. So he's always going to have an eye on the stock market. So, not only have we got central banks backstopping the equities market, we've also got the US government needing to backstop the US market as well. So I don't think we're going to see anything too protracted between now and the election at the end of next year. Now, the US dollar finished down a little bit, not a lot, but there was certainly plenty of volatility during the week. So let's jump in and take a look at the US charts. So we'll start with the S&P. There's the monthly chart. This is 2009. This is 2002, just to give you a bit of perspective. So this is a very big picture chart, and you can see that the trend is still intact. So if you're an investor, that's really the chart you need to look at. We've still got all the moving averages heading up. We've got the price above the moving averages. We're still in uptrend. So that's really the long and the short of it. If we zero in on the daily, you can see we did have quite a big dip. So this was the Fed and Trump, tweeting various things, and then the yuan devaluation, or not. They didn't actually devalue it. They just sort of stepped back and stopped holding it up. They just really let market forces take over. And that's the ridiculousness of all this currency manipulation claim by the US. In actual fact, China has actually been holding its currency up rather than manipulating it. So, as I said earlier, it's complete nonsense, all this stuff, so you can just ignore it. So that is the S&P. We're still in uptrend. 50-day moving average is still pointing up. It's still diverging from the 200-day moving average. So it's really no issue at all what's happened in the last week and a half. If we turn to the US dollar, then you can see it was pretty volatile and has been volatile now for some time, and finished down a little bit. Moving on to the Australian dollar, we plunged quite sharply, and on Wednesday we're actually trading down at I think we were at 66 something at one stage on Wednesday. So the Australian dollar has certainly declined very, very sharply. We do have support here, as I pointed last week, so you can see we basically bounced off support. Let me just put that line in there, picking up these lows from 2016. So we've reversed off that support, which is what you'd expect, but highly likely that we'll break this support, and then you've got to go all the way back to 2009 when we were trading down in the mid 50s. And I'll have more to say about that in the next slide. But certainly lower levels in the Australian dollar look probable. So Aussie stocks, 67.8 was where we eventually finished after a bit of a bounce. And there's now a lot of media attention on comments made by the Reserve Bank Governor Philip Lowe about the possibility, so at least he's now put it on the table, the possibility that if certain developments occur overseas and in Australia, that the RBA could actually take rates to zero and commence some sort of unconventional monetary policy, being some sort of quantitative easing, be that the government buying Australian bonds to inject money into the economy, or perhaps directly feeding liquidity into households. So it's never been done before on either score, but it's certainly the RBA has now put it on the table, and you've got to step back and think about why would they do that. If they didn't think it was at least some sort of possibility, why would they even put it on the table? So you've got to start to assign some sort of probability to this now. Through the week, we saw three central banks, New Zealand, India and Thailand, deliver larger than expected cuts in rates. So everybody's doing it, and that's really what the Central Bank of Australia is really signalling. Now, what Philip Lowe did say specifically was that if the RBA was to take that direction, that it would require the world effectively going to zero rates. Well, they're certainly headed in that direction. Most of Europe is, and other parts of the world are rapidly heading in that direction. So the possibility of rates around the world being effectively zero in the next year or two is not unrealistic at all. The second part of what Philip Lowe said was that if the Australian economy was weak, well, I think that's also a distinct possibility. So both of those criteria that he has tabled are entirely possible. They're not unrealistic at all. So, I think that's possibly where we're heading. And if that's the case, then I think you're going to see the Australian dollar continue to decline. Because at the end of the day, the Australian dollar performs badly when commodity demand falls off, lower economic growth around the world, and also when there's an element of fear. The Australian dollar never does particularly well. Our 10-year bonds are now yielding less than 1%. So if you lend money to the Australian government by buying their 10-year bonds, then you're going to get less than 1% return on your money. So it's no wonder that so many investors that have never normally been in the stock market are being forced to take more and more risk because they can't exist on a 1% return. The ASX 200 fell 184 points on the week, 2.7%, so a lot worse than the US market. But then again, in the month or so leading up to that, the the Australian market had outperformed. We had done better. So that was really just a correction to bring it back into line. There was huge selling throughout Asia. Monday and Tuesday were sharply down in Australia. And then we got a bit of a cautious bounce, but that bounce only came back about a quarter to a third of what was lost. Earnings season just starting in Australia. We're already seeing a lot of industrial and old economy kind of stocks offering weak outlooks. The services sector is certainly looking better at this stage, but you can be sure that earnings season is going to add to the volatility. So let's just have a quick look at the Australian market. So there we go, two heavy falls Monday and Tuesday, and you could see small rebound, took back about a third of what had been lost, but not that impressive. And you'd have to think that that a C leg down, so another leg down, so there's the A, there's the B leg up there, and a C leg down is pretty likely at this stage. Turning now to precious metals, this is gold on a weekly big picture view. If you take this decline from the top of 2011 to the bottom in December of 2015, then you apply a Fibonacci retracement scale to it. The 38.2 was at 1377, and that's where the market went to in the first half of 2016 exactly, and then turned down. We then rallied up to it on 2 or 3 more occasions, but all the while we were forming basically higher lows through this period. So we had this ascending wedge pattern. The next level kicked in at 1479. That was the 50% retracement of that major decline. And as you can see, we just basically went straight through it. So it didn't provide any real resistance at all. So we went through it, and we ended up closing above it on a weekly chart. So the next level up here is at 1581. So expect to see a bit of resistance there, so just short of $1,600. But look, the thing that's driving this is that the gold market is such an incredibly tiny fraction of the total world's financial system that is invested in bonds and in stocks. And if there is even a tiny reweighting, a really, really tiny reweighting from bonds or equities into gold, because funds and major institutions are so incredibly underweight gold, doesn't take much of a shift. And the impact on the gold price is going to be very, very substantial indeed. So I think, that's what we're seeing. We're seeing a progressive, probably only absolutely minuscule at this stage, reweighting into the gold sector. But the gold sector, in terms of weighting around the world in financial assets, could possibly have a long way to go. Now, that's not a guarantee and it's not a prediction. It's just that is the size of the potential upside that could occur for gold. Just zeroing in onto the daily, you can see it was a very positive week. We had 3 very strong up days, and then we're basically able to hold around that 1500 level. So breakout and then held, which is really impressive. If we go to GDX, you can see also, let's just go on a weekly first of all to put it in perspective. So we've broken this key resistance level at 25.5. We then had another resistance level around just under 28, and now we're coming up to the next resistance level, which is the equivalent of the 2016 highs. That's around 31.5, and GDX finished at 29.5. So there'll be some more resistance come up in the next couple of dollars, but clearly you can see from this little box down the bottom here, this is showing the line is heading up, which means that GDX is outperforming the S&P index. And one of the realities of the US market is that fund managers cannot afford to underperform the S&P index for very long, because there's just too much competition for funds in America. So they've got to continually be seeking out sectors that are outperforming the S&P so that they can at least keep pace with their competitors. So the fact that we've now got clearly this bottomed out in October of last year, so we're getting on towards nearly a year now where GDX has been outperforming the S&P. And so more and more fund managers have to respond to that situation. So it becomes a self-propelling spiral in the upwards direction. Can always reverse, of course, and come back, but there's certainly a very strong trend in place there now. So gold up $50, and the trend is really up in whatever time frame you want to look at. Now, with our weak currency as well, that took the Australian dollar gold price above $2,200. So our gold miners, most of them with all-in sustaining costs between $1,000 and $1,200, are making huge margins at the moment on their production, and with possibly a lot more to come. We've got two things happening here. We've got the Australian dollar going down, and we've got the US dollar gold price going up. So the Australian dollar gold price is going up at a very, very rapid rate. And of course, what happens with gold miners is, because of the leverage that a gold miner offers, where they've got they've got fixed costs, and so every incremental increase in the gold price just falls straight to the bottom line. So because of that leverage, then gold stocks have got substantial potential upside. You may recall a week or two ago that GDX had a huge one-day reversal, and then that only lasted one day, and then it promptly went straight back up again. Let me just go back to that chart. Now, I believe that you cannot afford to ignore these sorts of situations. So let me just put that back the way that it looked. You can't afford to ignore a day like this, because it's a huge reversal when the price is considerably extended above the moving averages. There was massive volume associated with it. You've really got to respond. If you've been trading gold stocks and you've got a lot of profit, as all of our members did, then I don't believe you can ignore that. And so you have to respond to it. And we did. And my recommendation to members of my various services was to take between 30 and 50% profit off the table. Now, in hindsight, that wasn't the best decision, but we can always be wise in hindsight. And the next day we got that. Now, I don't know what caused this first day on the 31st of July, and it doesn't really matter. It's probably just algorithms doing what they do. And then we got this huge reversal. So as soon as you get that huge reversal, then you reload. And that's, in fact, what I told members to do. So we took some profit, and then the next day or the day after, we reload. And, sometimes that's just what you've got to do. I still, I always go back and I examine the decisions that I make to see if I could learn anything from them, to see if I could have made a better decision. And I think if I had to play that one again, I would do it exactly the same way. Sometimes you have to respond to what the market shows you, and then a day or two later or a week or two later, you've got to put the position back where it was. But I think that's just the way that you have to play markets these days. Okay, covered that. So other commodities, copper didn't drop and went up. Sorry, it went up slightly to $2.60. I think it was $2.57 the week before. Crude oil was pretty volatile, as you'll see from the chart, and it dropped another dollar and a bit to 54.5, but it was pretty volatile. There's the spot copper chart, and there's the crude oil chart. So you can see it was a pretty big week. We went from close to 56, got down to 51, and ended at 54.5. So real roller coaster for oil again. So to wrap it up, I think you need to be responsive to technical patterns. Markets are moving so fast these days, so many things are stretched that I don't believe you can sit back and say, well, the fundamentals are okay. I'm going to sit with this, because often you might be 3 to 6 months behind in getting a new set of data, whereas the insiders already know that a company's fortunes are changing, either for the better or for the worse. So I think you need to be responsive to technical patterns more so than the fundamentals, because they give you such an earlier read. But it's important to understand that the majority of price moves are just noise, nothing more. It's the reality of ETFs and algorithms, as I talked about at the start of this video. It's not human beings changing their outlook and therefore starting a new trend. Now, from time to time, that will happen. We'll form a major top in the market and we'll go into a larger correction, which could be 15 to 20%, and ultimately we will go into a bear market. But until that actually happens, a lot of this short-term price movement, even though it's scary and it's volatile, is really just noise and needs to be treated just that way. So the algorithms will definitely get you if you allow them to. What is so important is to have clarity of purpose about what you're doing, the sort of trades or investments that you're making, the time frame that you're making them under, the level of volatility that you're prepared to accept, and from that comes a process which you should stick to with some degree of consistency as long as it works. And they're the essential part. If you don't have clarity about what you're doing and what kind of investments have got your name on them, and you apply some sort of consistent process, then the sort of market we're going to have in the future is going to make it extremely difficult for most people who don't have those things. Portfolio analysts just continuing to focus on the growth stocks. That there's some tremendous growth stocks in Australia, and also expanding and continuing to monitor the 10-bagger portfolio, which is already bearing some fruit. So that's it for this week. There's my contact details for anyone who's not a member of any of the various services that I have, and we'll see what the coming week brings. Cheers.